Now, it took more than a year, but the effort to pass financial reform legislation ended today as U.S. President Barack Obama signed the Dodd-Frank Act into law. Now, according to officials, this is the most sweeping set of changes to the way big financial firms go about doing their business since the 1930s. But not everyone agrees with this notion that the bill will actually prevent a future economic collapse. One of those people? Gerald Celente, director of the Trends Research Institute, and he joins me now. Gerald, you know, we keep hearing that this bill is necessary to prevent another financial crisis like the one we saw 2 years ago. You seem to disagree with that. Why is that?
Well, we definitely need a bill that will prevent another financial crisis. This one isn't it. You know, Washington, the White House lies, and the media swears to it. This is not the greatest financial reform since the Great Depression. The greatest financial reform since the Great Depression was in 1999, the Graham-Leach-Bliley Act, under the Clinton administration, that deregulated the financial reforms that were put into place. Look at the facts. When the House and Senate passed versions of this bill, the stock market voted. The banking stocks went up, and so did the Dow. This is merely a whitewash for the white shoe boys on Wall Street. It does nothing to prevent the coming crash of 2010. The bigs only got bigger.
So what needs to be done then? I mean, what would you propose if you were on the Hill to, quote unquote, as you say, prevent this looming crisis of 2010?
Well, number one, I'd get the Wall Street boys out of the White House. They're running the show, whether it's the head of the Commodities Future Trading Commission, whether it was the former Treasury secretaries, whether it's the assistant to the current Treasury Secretary, whether it's the current Treasury Secretary. First, you have to get the crooks out of the White House. Number two, reinstall the legislation that was put in place, such as the Glass-Steagall Act during the Great Depression, that prevented the banks from consolidating, which means becoming brokerage firms, investment banks, insurance companies, all under one roof, under the guise that they were going to create a one-stop financial supermarket. It was a one-shop financial super scam that now has 10 big banks controlling 80% of the assets. The numbers speak for themselves.
So given your take on this particular issue and this piece of legislation, who do you look to, if anyone, in Washington, D.C. to execute what you're suggesting? I mean, is it the Democrats, is it the Republicans, or are you saying that everyone's sort of out of touch here and in bed with Wall Street?
Well, again, they're not out of touch. You said it. They're in bed and paid off. Just look at the numbers. They're out there. How much money came from the financial sector, and lobbying went on to water down this bill into the nothing whitewash it is. The only one that, to me, seems to have a firm grip on all of this is Ron Paul. Other than him, you know, and another couple of others, Issa possibly, I don't know too much about his other statements and issues on this, but Ron Paul seems to be the only one with a firm grasp on how the Federal Reserve, for example, being ahead of the Consumer Protection Unit of this great financial reform. Yeah, how about putting the Bloods and Crips in control of law enforcement? So Ron Paul is really the only one that I see of any credibility.
It's interesting that you mentioned the Federal Reserve because, of course, the legislation would establish a Consumer Financial Protection Bureau inside of the Fed. You're obviously not a fan of this institution in general, and neither is Ron Paul. But, you know, the officials are saying we need to give them more power as a protective measure. How did they justify that, given everything you just said?
Well, because Wall Street's controlling Washington. The Federal Reserve's in control of the country. So that's why they could do what they wish. And, you know, there's a very symbolic element to this as well. Look where President Obama signed the bill, at the Ronald Reagan Building in downtown Washington, the champion of deregulation. So Wall Street gets the message. It's business as usual for the white shoe boys.
Now, you mentioned this a little bit earlier, but let's talk about this notion of too big to fail, because apparently regulators are going to have the power to take down failing giant financial firms. Help us understand how they could possibly go about doing that. And then we also have to consider that a lot of these reforms, or as you would say, supposed reforms, are going to take years to actually be implemented. So there are a number of years that Wall Street sort of has this wiggle room.
Well, first of all, the whole issue of derivatives is a side issue. It was much bigger than that and much bigger than the subprime problem. Wall Street is nothing more than bookies in Brooks Brothers suits. Credit default swaps, auction rate securities, special investment vehicles. The whole thing is a rigged game. Number two, it's not going to happen under the legislation that's in place for reasons that I pointed out. And in terms that they're still playing the same games, and they've made the too big to fails entrenched. Look, 2/3 of the credit card action is controlled by 3 major banks. You don't have to be a mathematician to add up the numbers here. So when they're talking about the public won't have to bail out the too big to fails, that's just not true. Because what they did, there was $19 billion that the banks were supposed to put up in the event of such a catastrophe. But they didn't put it up. It was whitewashed out of the bill. So that means that the public will foot the bill, and then they'll say that they're going to the banks now to collect on it. So when the too bigs to fail, the public will again be left holding the bill.
Gerald Celente, director of the Trends Research Institute. Always good to have your analysis here on RT for us.